Hello and welcome to the Data and AI podcast, a monthly show where we pick the brains of some of the most influential people in the data and AI space. My name is Sam Maughan. I'm a director at the Harnham Group, and if you haven't heard about us before, we specialise exclusively in data talent solutions globally. I'm part of our senior leadership team. I've worked at Harnham for a decade now, and I've been working in that space throughout that period. Today's topic is a very, very exciting one, one that's very close to my recruitment experience as it's a vertical that I started in, and it's everything credit risk analytics. We've got a very, very exciting guest on today, someone who I've personally got a great relationship with. We've worked together many, many times over the years, and he is going to talk us through credit risk from start to finish, share some of his experiences within this industry as well, and we're lucky to pick his brains on hopefully what's to come too. So today's guest is Tim Trailor. Tim, welcome. How are you?
Very good, thank you.
Good stuff. So Tim, just to kick us off, could you tell our audience a bit more about who you are?
Sure. So I guess maybe if I give you a bit of a summary of my background. So I've been in credit risk for about 20 odd years. First 10 years, very traditional. Started off at Capital One, spent a few years there, moved to Barclays, where I spent a few years, and then Lloyds Banking Group. Post-financial crisis, I spent a few years in Payday lending, which was a really interesting kind of part of my career, and then really moved into fintech. So about 2016, started at Klarna, where I led their global fraud team and also the UK credit team. Spent a bit of time at Monzo, where I led the lending business, and then a small credit card provider called Capital on Tap, where I spent a few years as well. I'm currently at a company called Inviso, which does credit solutions and risk solutions for payments companies.
Awesome. And I know we've worked together for a number of years. We mentioned in the intro there that we wanted to go through, I guess, from top to bottom risk. And I think it would be great if we started right back at the beginning of your journey. And I know we've talked about this before, but Capital One was obviously somewhere where you started out, and that was where you kind of forged your career in credit risk. Could you maybe give us an idea of what it was like back then compared to what it is like now, and what were the big differences?
Yeah, I mean, Capital One was a really interesting place to learn about credit risk. It's taken it takes a very different approach to what most, particularly the traditional lenders, do. I interestingly, I went from Capital One to Barclays, which was kind of a really interesting comparison, because Barclays is very much, there's a credit risk team. Your job is to make sure losses don't go above a certain level. There's a marketing team, and their job is to make sure they generate a certain level of revenue. And there's not really a lot of arbitrage between those two. Those two teams work on their own goals, and they'll obviously collaborate, but they don't really arbitrage between the goals and work out, should we be taking more risk, should we be taking less risk. That's really only done at the C-suite level. Capital One operates very differently. So they've got a marketing and analytics team. And their marketing and analytics team is responsible for both the revenue and the losses. And they really work on things like net present value models. And that creates a common language between the marketeers and the credit risk analysts, which means that they're really thinking, everyone in the organization is aligned to and thinking about, how do I generate shareholder value? And that creates a very different mindset and a very different toolkit to the traditional lenders. And I think it's one of the reasons, if you look at the kind of C-suite and the senior execs in a lot of fintechs, a lot of them come from Cap One. And I think that the real driver of that is the fact that you're taught to think differently and approach credit risk in a much more holistic way, rather than we just minimize losses. It's not about minimizing losses, it's about generating value.
And it's so interesting you say that, because I think from a recruitment perspective, we have seen that in a lot of the successful businesses. There's always not always, but there's typically a real Capital One theme running throughout it. I know the businesses that you've been involved in. Why do you think businesses now don't, or maybe you do, but why don't we see so much of that business acumen being taught now? And why have all of the jobs maybe come a bit more siloed compared to what they were before?
I think it's joining the dots of the different specialities is still really important in businesses. And that's something that will always be there. And the most successful businesses will be the ones that do that really well. But it is true that there is much more depth to credit risk now than there was 20 or 30 years ago. I mean, whether it's machine learning models and the multiple techniques. Back when I started my career, it was pretty much logistic regression was the only technique anybody knew about.
Yeah.
Maybe a basic decision tree, but it's much more basic than it is now. So I think that the tools, and I mean, now you're getting into artificial intelligence and large language models and using those in some of these areas. The tools have become more specialized, which means that people are specializing their careers in those areas. But I think the way to get the best out of any business will be to join the dots of those areas and make them all work well together. So I think there's still very much a place for joining those dots, but it's just that because it's become so specialized, it does mean people are specializing earlier in their career.
Yeah. And even prior to that, you obviously, there was a statistics and mathematics theme throughout your university degree. What made you want to make the step into analytics and credit? Because I guess back then, it probably, not that it is super sexy now, but it's definitely sexier, that career. What made you want to go down that route?
So I did a physics degree. And I got to the end of my physics degree and I realised that there wasn't any money in being a professional physicist. I mean, maybe the very top ones, but I'll be honest, being an academic is a fairly thankless task.
Yeah.
So I knew I wanted to do something that I found interesting and challenging, but I knew it wasn't going to be in physics. Even though I found that interesting and challenging, it just wasn't going to be rewarding enough. It wasn't going to provide the lifestyle I wanted, frankly. So there was a person in the year, or a couple of people in the year above me who went to work for Capital One. And Capital One at the time were really trying to hire the brightest and best in the industry. And I think they still try and do that more than most of the traditional retail lenders. And they were hiring from the same pool of graduates as the McKinseys and the kind of, those kind of BCGs of the world. And we're trying to really hire and develop an incredibly high standard of talent. And the problems they were solving, and I'll be honest, the problems in financial services are very interesting problems. And numerically, kind of the dynamics between marketing and credit risk and collections and how you acquire customers and how you make them successful and how you develop products is a really interesting dynamic problem. So being able to apply that kind of toolkit you'd learned at university to that problem was really what attracted me. And the fact they were doing it in a very, I think, high caliber way was very attractive.
Yeah, definitely. I think even though I have nowhere near the academic career that you have, I think what always interested me about credit risk was that you could relate to it. It was very problem solving focused, because everything that we talk about with credit risk, whether it be loans or mortgages or credit cards, I know obviously it's become a bit more complex now, but they're real life problems that you could solve. And something you alluded to there right at the start, Tim, in your experience was obviously payday lending, which at one point kind of blew the industry wide open. And I know we felt it from a recruitment perspective. We just found, Wonga were the first to sort of lay their marker down. You've obviously spent some time in payday lending. What was it like when it first landed on the scene?
I mean, when I was first approached by payday lenders, and asked would I be interested in a role there, I'd never heard of it. And I was blown away by the interest rates and the APRs that were present in the industry. But then I started looking into it and I realized the representative APR calculation requires you compound the interest. That's a mandatory part of the calculation. But actually, the way Payday works, you've got to pay off the interest every month. You never charge interest on interest. That never happens. The lender I joined didn't charge any late fees. And when I joined them, they charged £25 per £100 borrowed. So you'd borrow £25. A month later, you'd owe them. You borrow £100, a month later you'd owe them £125. If you didn't pay that back, 6 months later they were still chasing you for £125, or a year later they'd still chase you for £125. And the collections tools and techniques they were using were the same as every high street bank. The credit checking they were using and the affordability checking they were using was largely the same as the high street banks. So for me, actually, from a ethical perspective, the fact that interest didn't compound, people that were only ever chased for that £125 really helped. And the fact that tools and techniques and the collections approaches were pretty normal reassured me. And I also spent quite a lot of time. It was interesting because I went from a large business, Lloyds Banking Group, to a payday lender. And I'd gone from an organisation where you didn't really ever speak to customers to an organisation where it was very easy to go and hop on the phones and do call listening and speak to customers. And actually, in a lot of cases, the customers we were dealing with really appreciated being trusted with a loan, and it was quite unusual for them. They were so used to being told no. The kind of not quite moral, but that the impact it had on their own self-perception was really important to them, and it really gave them a boost that someone was willing to trust them with money. So I actually think there were rights and there were wrongs of Payday from an ethical perspective, but I think I still believe there is a place for providing credit to that cohort of customers that I think increasingly are excluded. The other thing, so that I guess that's the moral side of things, but also from a training ground perspective, it was fascinating. I learned so much because if you're lending someone £100, you can't afford to have many calls to them. You can't afford to chase them in collections dozens of times. You can't afford to go through lots of documentation. You can't afford to do some of the processes you could do for a £5,000 or a £10,000 loan. So you've got to think in a really automated way. You've got to have really automated credit scoring, really automated affordability checks, really automated collections processes. And I guess it was the forerunner in many ways to fintech, but learning how do you do a fully digital onboarding journey where you meet all the regulatory requirements, but you do it in a digital way and in a way that delivers the funds in 3 or 4 minutes. That was a really interesting learning experience for me.
Yeah, no, I bet. And you talked there about some of the challenges from coming from what we would deem as sort of traditional banking. What was it like culturally to move to a company like that? Obviously, much less people, or fewer people, I should say. What was it like for you going from your sort of Capital Ones, HBOS, etc., Barclays through there?
I learned something across the early part of my career. So I really enjoyed Capital One. I found it a great place for learning the mechanics of how lending works and really plugging them together. I then moved to Barclays, and Barclays is a very disciplined and very good organisation, but it was very siloed compared to Capital One in terms of what you're trying to achieve was very much single metric driven, whereas Capital One was much multi-metric driven. And I kind of missed a bit of that dynamic thinking about lending when I was at Barclays. And when I moved to HBOS, I got a role that was a little bit broader. So my role at HBOS, which was taken over by Lloyds Banking Group, was looking after effectively customer relationship management. So customer dormancy, customer retention, loyalty schemes, those kind of areas. And I really enjoyed going back to something a bit broader where you have multiple dimensions to play with and you can look at things through a few different lenses. And then when HBOS ultimately failed and was bought by Lloyds Banking Group, I was mapped into roles and effectively had two lots of people in the two different credit card businesses with 100 people each, 200 people each, whatever the number was. And they made relatively few redundancies and they ended up with a team that was 180% the size of the original two teams. And that meant that everyone's roles got narrower and deeper. So my role was going to get much narrower and look after, for example, just retention or something like that. And I realised in that I really enjoyed the breadth and the multidimensionality of things. And that's really what led me into payday lending, because my role suddenly went from being optimising a very narrow part of the business to marketing and credit risk and pricing and collections and customer retention, all these different aspects. And that's what I find fascinating in lending. It's joining the dots of all those different parts.
Yeah. It's something we talk about with candidates and clients all the time. I think ownership comes up a lot. People want to have ownership. And I think we'll talk about it loads today, but I think that definitely shines through there. I think compared to some of those bigger organisations, however it might be, roles got more and more siloed, whereas a smaller-ish organisation, you were able to own more. Something else we're going to talk about loads today would be obviously regulatory challenges, and I know you've obviously experienced those throughout your time. What regulatory challenges did you find when you first sort of veered into payday lending?
I mean, I think the obvious one was that there wasn't a lot of regulation designed for payday lending. So there was a lot of regulation, but it was largely designed for other types of lending. So, for example, there was regulation that said you had to do an affordability check, but it didn't say what that check was. And even back then, there was a certain degree of kind of principles-based regulation, and there was a lot of interpretation around what did that mean. And I think the entire industry made the assumption that because we're lending £100, we should be at the light end of what is required. So we can interpret this relatively lightly. And actually, the interpretation the FCA clearly put on it when they came in was, no, you're lending to an inherently vulnerable set of customers because they're taking these higher interest rates. And if you're lending to an inherently vulnerable set of customers, you need to interpret them at the more severe end of the spectrum. And there was that clear expectations gap between what the FCA expected and what the industry had thought they would expect. And I think that's ultimately what caused, frankly, the downfall of the industry, was that the industry, and it wasn't one player within the industry, I think pretty much all the players within the industry had misinterpreted the rules.
And what do you think the biggest lesson for those? I know some of these businesses aren't around anymore, but there has been, I think, lots of lessons learned from it, and businesses have kind of taken the good and built that into their future businesses. What do you think were the biggest lessons that, whether it be any lender or bank, might have learned from payday lending?
I mean, I think firstly I'd say the regulator has got much better at being clearer. And
Yeah.
That's constantly over the years clarified and given more guidance to firms, which allows firms to have much less ambiguity and room for making mistakes than they did before. So I think the regulator has got a lot better. But I also think the lenders themselves have started to understand what cultural changes are needed. So so when I started in Payday, actually the FCA didn't exist. I started back in the old FSA days. And one of the big changes the FCA drove when it first came in, even before it started driving with, and I think treating customer fairly was part of this journey, but it was the concept of corporate culture and what the culture needs to be. And I think lenders now more than ever understand what type of culture they need to have and what type of culture they need to drive. Whereas I think previously there were a number of, actually it was pretty commonplace that they just didn't think too much about their customers or what the customers, they thought about the P&L, about the products they were delivering, and they didn't try and game the rules, do anything wrong, but they didn't put the level of thought into, are we really delivering great customer outcomes? And I think that change in culture towards, am I delivering something really great for customers?
Yeah,
is something that's, and as long as you've got that in your mind, as long as that's your mindset, generally you'll be doing the right thing. So I think that cultural drive is probably the biggest thing that's changed in the last 10, 15 years.
Yeah. And obviously post Payday, there was a huge emergence of fintechs, obviously 2 or 3 of which you've had experience working with. Again, from a recruitment perspective, it's been kind of booming ever since. It slowed down a tad these last year or so. But why do you think so many emerged and so many focused purely on lending? Where did that come from?
I mean, I'll start by saying I don't think the banks have done a great job. I think there was a relatively small number of relatively legacy businesses that weren't digitally focused, weren't really talking to the latest demographic. And I actually think demographically we've seen a massive shift. I guess 10, 15 years ago, there wasn't this. I think millennials and Gen Zs are very different to the Gen Xers and my generation. And I think the banks were not recognizing that demographic shift that was happening, and the move to digitization, the expectation for great services through their phones. And I think what happened was that the fintechs recognized that much quicker and reacted to it much quicker and provided much better products and services than the banks were doing. The banks have largely caught up, but they've largely caught up by copying what the fintechs have done. And I don't think being a copier is going to be good enough in the future to be a real winner. So my hope is that organisations like Monzo continue innovating, continue leading, and I'm sure the banks will continue copying, but it's hard to be a winner in the long-term sense if all you're doing is copying.
Yeah, absolutely. And if we could get into that further, that would be great, because I think I completely agree with you. I think from the bank's perspective, back then they were very rigid, and I think the emergence of fintechs caused a few things. One, I think, as you say, they were able to appeal to a younger audience. I think the likes of Monzo are a great example of that, right? But also, I think that fintechs emerged with new technologies as well. They were using Python, which was obviously never really used in banks before. They were always very typically SaaS, and that was it. Why were they able to use more open source technologies? Because typically what we found was from a regulatory perspective, obviously SaaS was widely used because it was trusted, whereas Python open source wasn't. Why were fintechs able to use open source tech versus the banks?
Yeah. So I think there's two different dimensions here. One is the tools, and one is the technology we're deploying those tools onto. So if we start with the tools, so SaaS had been around for a long time, been very widely used, very trusted, good, safe, stable platform. You can build great models with SaaS, but very expensive from a licensing perspective, and can only iterate at the pace at which SaaS, the company, develops software. But it had a huge incumbent advantage in that all the banks had big teams that knew it. They had repositories of code that were written in SaaS, and retraining their staff and rewriting those code depositories was a massive job. So they were kind of, to a large extent, stuck with that tool. The fintechs came in, and they didn't have large repositories of tools. They could hire, they had relatively small teams that were quite easy to hire, and actually a lot of their teams were, frankly, quite often younger from different industries. I mean, I remember at Monzo, there was a lot of people from Deliveroo and Facebook and other industries that had different tooling, so they were familiar with different tooling. So I think that made the switch to the new tools much easier for the fintechs than the banks. There's then the other side, the other dimension, which is the actual what you do with that tool. And SaaS was very well built for logistic regression and some of the older and more traditional techniques and decision trees and things. It wasn't natively built with machine learning, XGBoost, and kind of random forest models in mind. So it could only iterate really at the pace at which SaaS evolved the software and provide the extra tools. But because Python was open source, everyone could contribute and everyone could write libraries for it, and everyone could speed it up, speed up the development of the tool much better.
Yeah.
The banks were also, and I think you were kind of alluding to this, also hindered by another thing, which was when they were, particularly with the new techniques, if you're moving from logistic regression, it's very explainable. You can give someone the kind of the formula, if you want, for logistic regression, and they can see how it's built up and how someone gets a credit score with it. Something like XGBoost, you can't. It started off as a black box model where you get a series of inputs in, something goes on in the background in this black box, and you get an output out. And it's now more explainable than it used to be, but particularly for the regulators, they weren't natively or naturally comfortable with that black box approach. And I think over time they've become more and more comfortable with it. Plus, there's been much more research and development around how do you explain things like an XGBoost model than there used to be 10, 15 years ago. So it's more explainable, and the regulators got more comfortable with it. So I think now the banks are starting to be much less restricted in how they use it.
Yeah.
But I think there was that period, probably of 5 years, when the fintechs were using tools, and they also didn't have capital concerns. It's not like there's a PRA breathing down the neck of a fintech, because they don't have a banking license. I mean, Monzo is, the digital banks are an exception, but the likes of Klarna, for example, or a lot of the Lendable. I mean, not picking on any individual names. I don't know anything about Lendable, but they didn't have, because they don't have a banking license, they don't have capital requirements, and they don't have the PRA, who is probably more strict on models and model governance than even the FCA is. So that was a extra constraint the banks had to deal with that fintech lenders didn't.
Yeah. And I guess from an attracting talent perspective, the banks for a while there, if they wanted the best people, I think the best people wanted to use open source tech. And again, we'll get into this a bit later on when we talk about some of the data science collaboration between risk. But we found for a while that, again, a lot of the best risk talent, if they wanted to use open source tech, they couldn't go to banks. So they were almost forced to go into fintechs. And something else that really boomed is buy now, pay later. I know you've got some heavy experience in that space as well, and it's something that continues to grow. And I think the emergence of it, again, a bit like payday lending and fintechs, not came out of nowhere, but it definitely boomed, and it's continuing to doing so. Just for the viewers that maybe don't know what buy now, pay later is, could you just give us a bit of an overview?
Sure. So, I mean, the concept of buy now, pay later is that you purchase something at the checkout, and then you'll get an invoice, or you'll get some method to pay some period later, 30 days later. I mean, Klarna, so I joined Klarna back in 2016, which was before I'd ever heard of Klarna. It was interesting. I think I got a call, I can't remember if this was off you or one of your colleagues, saying there's this strange Swedish organization that's looking for someone in kind of credit risk space. And I had to Google them and find out what they did. went over to Sweden for an interview, and that was the start of a couple of good years with them. But it's interesting because people think of buy now, pay later as a financing tool, and they think of the advantage of Klarna, for example, as being hey, I don't have to pay for this for 30 days, and that is an advantage of Klarna, and one reason why it's got traction. But there's a much bigger advantage, and the reason why it's kind of had the flywheel effect it's had, which is it's actually the smoothness of the checkout process. So I remember the first time I used Klarna, I went on to checkout, I clicked buy, and then I just got a pop-up that said, great, it's on its way to you. And I hadn't put any card details in. Hadn't told them anything about myself really, other than had my name, my address, I think I put in my date of birth. And that was about it. And Klarna's process kind of works by effectively doing all the checks in the background. It'll do a credit check, it'll assess me, it'll verify I live that address, I'm on an electoral roll there that the good's going to get shipped to. And then it'll ship them. And then they'll send me an email in 15 days' time, say, hey, you need to pay us within another 15 days, or whatever the timeline is. And I then click on the link in the email and make a payment. And it separates out the purchase from the payment for that purchase. And that separation of payments from purchases was quite revolutionary. And that, for merchants, meant that the dropout rate on their carts was much lower. So they're selling more goods, which means that they're willing to pay Klarna a premium. So Klarna would charge them 2 or 3% or whatever the rate would be for having Klarna on their checkout and for the goods that are purchased through Klarna. And that's what fundamentally pays for it. And that concept of making the merchants being willing to pay for a smoother process, because that smoother process generates more sales and it's less frictionless for customers. I mean, how many of us have gone to a checkout and it says, what's your CVV number? And you go, I've no idea, my wallet's downstairs, I'll sod it, I'll do it later, and you never get around to doing it. And just making that process smoother is one of the really big wins for Klarna. And I think that it's interesting because I think there's been quite a few other players have entered, but have entered much more heavily on the card rails, would want the card payment at the time, or pay a third now with the card, and then we'll charge a card in 30 days, 60 days for the other 2/3. And I fundamentally think they're missing a bit of understanding on what good buy now, pay later is. And I think Klarna is really, I think that's one of the reasons why Klarna has been so great and done so well.
Yeah. And I think it's similar to what you were talking about earlier. I think, correct me if I'm wrong, obviously you know it better than me because you worked there, but they thought about the customer, and I think instead of thinking about bottom line or P&L, they thought customer first. And I think, as you said, you're never going to go far wrong there. Where did it come from, buy now, pay later? Where was it born?
Yeah, so I mean,
why was it born?
The first I know of buy now, pay later was Klarna in Sweden. And I'll be honest, I don't think buy now, pay later could have been born anywhere other than the Nordic market. The loss rates you see in the Nordic market are crazily low compared to Anglo-Saxon markets, the UK, the US, and even continental European markets. The Swedes are just very good payers. They always pay. And there's also, I'll be honest, their regulatory system and the way the collections processes work, what they're allowed to do. I mean, nothing illegal, but just the entire setup in the Nordic market is very much supportive of lenders, and therefore they can do it at very thin margins. And they can do it at very thin margins because fundamentally they know they're going to get their money back. So it started in the Nordic market, and very organically. I think it was like the mid-2000s, like 2005, 2006, sometime around then that kind of Klarna started off, and you'll forgive me if I get the dates wrong, it was before my time there. Then expanded into kind of the DACH region, the kind of Germany, this kind of Swiss region. And I think that was quite a challenge for them, actually. That my understanding from that period, and from having spoken to some of the team that were around when Klarna moved there, they were a bit shocked that people didn't always pay them back. And it was a tough time, and the company kind of had to learn how to lend and how to underwrite well, and to how to get your money back, frankly. And then obviously expanded to the UK, and that was about the time I joined. They were just signing the first few big deals when I joined in the UK. We grew it pretty big, got kind of H&M and ASOS and a few others on board during that time. And then obviously launched into the US, I think it was about 2017, 2018. They really started growing in the US much more aggressively. So it's been a big journey for them, and they seem to still be doing pretty well.
And throughout all of the companies you've mentioned, you must have been involved in some pretty innovative projects. You've talked about a couple of them there, right? But I think it would be great to understand, because again, we talk about this a lot when we're trying to find top talent, problem solving, and especially if you're in a fast-paced business like you have been for so many years, you have to have the ability to problem solve. What do you think some of the hardest parts are of setting up a lending product?
The biggest problems that businesses tend to face, in my experience, is actually joining the dots. So, actually, a great example of this. Actually, I won't name the player because I don't want to kind of talk about individual companies. But there was a lender that was launched into the US, and in the US, it's quite hard to underwrite. There's a lot more friendly fraud. There's a lot more identity theft. There's a lot more problems like that make it quite difficult compared to the UK, where I'll be honest, the UK is a very data-rich environment, very clean data environment. Although there's still problems, but very clean data environment compared to the US. And moving from the UK to the US is challenging. And the first problem they faced was, okay, great, how do we underwrite and how do we make sure we only lend to people who are going to pay us back? And they solved that hurdle and they built better credit models, and we kind of made it work. But then what you find is that at the end of that, your acceptance rate is lower than it is in the UK, that you're only accepting 10% of customers instead of 20% of customers or whatever it would be. And then you start finding, well, hold on, my marketing channels don't work, because whatever we pay for our marketing, we're now accepting only half as many. So the cost per marketing dollar for every acceptance is double what it is in the UK. So you've then got to solve the marketing problem. So joining those dots and figuring out, how do I underwrite the right customers who are going to pay me back at the right price points? And obviously the high price, the more revenue you've got to be able to cover losses, but the more your best customers are going to get turned off. So you have this adverse selection issue. But then you've got your marketing channels. You've got to display your price in the marketing channels. How do you join all those dots to make it worthwhile and make it work? Those tend, in my experience, to be the hardest problems to solve, and the ones that require a little bit of iteration. You need to play with the settings as you go through the journey. But fundamentally, those are also the most rewarding ones, because those are the ones that take a business from not working to growing and being successful.
Yeah. And something that a lot of our listeners will struggle with, being leaders or managers, and something I think you've done extremely well over the years, because we've worked together, is building high performing teams. You hear about it a lot these days, right, on podcasts, like maybe not this one, but other podcasts where they talk about how to build teams and doing that successfully. And I think the challenge, especially within data and AI, is finding good talent. And again, I think something you've done really well is doing that. I don't think you'll have maybe a one-size-fits-all answer for this, but it would be great to understand what kind of things you go to when you're trying to build a high-performing or successful team.
There's two dimensions to, there's many dimensions I measure people on, but there's two dimensions that when you're hiring, I tend to focus on. There's what you know, and there's how you think. And I actually tend to put a lot of weight on how you think, because what you know we can change. We can teach people new skills, we can teach people new tools, we can teach people new things. But how you think, and evolving how you think and learning to think, and I'll be honest, my physics training and having done physics as a kind of undergrad course, I think I always think of physics as a way of thinking. It's that scientific mindset. And I think the same applies to hiring great people, as you look for people who think in the right way. I've used case studies quite heavily, and I know, this comes from a Cap 1 background. Cap 1 use case studies very heavily in their hiring processes. I know organizations like McKinsey and most of the management consultancies use them very heavily. And what I look for in those processes is, does the person think clearly? Can they structure a problem? Can they take data and use it in a useful way? Can they understand the problem? Can they approach it from different angles? And if you've got someone who can think in the right way, you can usually solve any knowledge gaps. If you've got someone who knows stuff but can't deal with a new problem or a new angle to something, that's a much more challenging people problem to deal with. So it's I always try and focus on potential, and particularly potential because they can think in the right way. And then you can deal with the knowledge gaps as they arise.
Yeah. And again, I think something we've talked about before is wanting to enable more people to enter this space, and reducing the barriers of entry. Are there any, I'm kind of putting you on the spot here, but are there any tips and pointers you'd give to someone trying to enter this space now? Again, if you were looking at your younger self, would there be anything that you'd say to people in order to maybe give them a bit of a leg up in trying to get into data and AI?
I think interest and curiosity goes a heck of a long way. I remember one of the people I was most impressed with in my career actually was, there was, again, I won't name names, but there was an engineer at Monzo who asked so many questions. But he asked so many questions because he didn't just want to understand the engineering. He wanted to understand the economics of the lending product. He wanted to understand the customers. He wanted to understand the dynamics. And that kind of curiosity, I think, made him a fantastic engineer. So I think anyone starting in their career, I'd say ask questions. Be interested. If you're working in credit risk, don't just attend credit risk meetings and think about credit risk. Go to the marketing meetings, go to the operations meetings, go to the collections meetings, go talk to your colleagues in other departments. Look at what their metrics are, what are their dashboards, how do they work, how does what you do affect what they do? Because I do think, I mean, they're specialising and people do need to specialise and will specialise, and most organisations are relatively good at training people on specialities and training people on how to be a great decision scientist or data scientist. What organisations don't tend to do for you is train you on how do you understand, as a data scientist, what the marketing team is doing, what the collections team is doing, what the operations team is doing. So if you do that off your own back, if you show that initiative and you go and learn those other areas and you will learn how it all fits together and how your area impacts theirs, and then maybe you want to spend some time as a data scientist in marketing or in another area, I think that roundness of knowledge is incredibly valuable. So anyone looking to get into the industry or looking to develop within the industry, show that curiosity and try and get involved in other areas rather than just your day job.
I think that's an awesome bit of advice. It would be amiss of us not to talk about AI, and it's something that is being talked about across pretty much every part of data at the moment, whether you're in credit risk or engineering or BI, marketing, wherever. And I really want to pick your brain on it because I know you've been in the industry for a long time and you've got an opinion on it. But I think the first question would be, where's it going to land within credit risk? Where do you see it beginning, or has it begun?
I think it has begun. So it's interesting. AI reminds me a little bit of machine learning, and before machine learning there was big data, where everyone used to say they were doing it, and most people, if I'm honest, weren't really doing it and weren't really doing it in a big way. And a lot of people would call logistic regression machine learning and call something that's bigger than a spreadsheet big data. So for me, AI now is actually there has been a genuine revolution in the last 2 or 3 years in large language models and the ability of computers to understand natural language and respond with natural language. And that has huge potential, and it has huge potential in a lot of different places. And if I'm honest, I don't think financial services in most cases has yet really even started to scrape the surface of what it's going to do. But I think we need to figure out, we're still figuring out where can we use it and where can we not use it. So, I mean, a great example actually that we're using my latest company at Invisto is Invisto was set up to help merchant acquirers deal with the risk of their merchants. So whenever a merchant acquirer processes payments for a furniture retailer or pub chain or whoever they're processing payments for, they inevitably have some exposure to that merchant's risk. If the merchant goes bust and any customers ask for their money back, the merchant acquirer has to pay that money back. So they need to understand what that merchant acquirer is doing. They need to understand whether they're safe processing payments for them, whether they need to have any kind of protection. And one of the places we're using AI is we're scraping things like review sites and Trustpilot and Google reviews and other review sites. And we're starting to classify, are their customers happy? Which is, okay, great, you've got the star rating already, that's easy. But if they're not happy, why are they not happy? Is it they're not processing payments well enough or not processing refunds well enough? Is it that they have poor quality products? Is their services bad? And then starting to be able to use that data to then understand trends. So how do you compare to other similar merchants? Are you better or are you worse? Why are you better or worse? And for example, if there's a merchant who is struggling with their payments and they're not refunding payments well enough, is that a precursor to getting chargebacks? So we can then look at the chargeback data and say, actually, this tends to be a leading indicator of a company that's starting to get bad reviews on payments and how they're performing on payments is probably going to start seeing a tick up in chargebacks. And you can actually use that as a early warning tool that can cause you to change how you're interacting with that company. So there's a huge amount of stuff that you can do with AI, but it's we're still just scratching the surface, and there's a long way for us to go before we really get to its full potential. I think it's hit us far faster than, big data was a bit of a wave, and then you had machine learning, which is a bit of a wave, but they all came over the space of a decade.
Yeah.
This has hit us in 12 months from, going from not having heard of AI. I think I saw some stats on how quickly ChatGPT went from no users to 1 million users, and it was like 10 times faster than the Facebook went from no kind of users to 1 million users. So it's hit us incredibly fast, and I think as people, we're still catching up on what does that really mean, and what can we use it for.
And obviously throughout your career, but especially with your current role at Inviso, you've obviously got a lot of exposure to the boardroom. It would be great to learn a bit more about what is the belief in AI like in the boardroom, because obviously data over the years has become trusted more and more, right? It's not like back in the day where someone used to put their finger up and see which way the wind was blowing. It's now, every decision now is based on data. Do you think boardrooms across the country who have influence on data teams, do you think there's a belief in AI? Is there any convincing that needs to happen still?
I'd say as a rule of thumb, there's possibly too much belief in AI, in the sense that AI solves every problem. This is going to fix everything.
Yeah.
Hey, we've got this data issue over here. Why don't you just get AI to do it? We need to write this bit of code. Why don't you just get AI to write the code for you? And it can do a lot of that, but it can't do all of that. So I think in boardrooms there is a big belief in AI, and I think there's a lot of willingness to invest in AI and a lot of willingness to use it as a tool. But AI is one tool in a toolbox with 20 tools. It's a very powerful tool. Don't get me wrong; it's an incredibly powerful tool. But I think the bit that's probably at the moment, again, lacking for the boardroom as it is for everyone, is just where can you use it? What can you do with it? How do you use it? And that is going to take some time for everyone to learn. And I think boardrooms are the same as all of the rest of us, where we're finding interesting and useful use cases, some of which will work, some of which it's probably not the right tool for.
Yeah. And you alluded to ChatGPT earlier, and Bard and tools like that, and some of the challenges that AI might pose specific to the credit risk industry or market. What kind of challenges do you foresee that might crop up if AI starts getting used?
The biggest challenge I see with AI, or the biggest problem today with AI, is hallucinations, and it affects everyone who uses AI. Everyone has, there's lots of case studies and examples of, you ask ChatGPT for an answer, and it'll give you the answer it thinks it should give, not necessarily the answer that's right. And I think that is a problem with AI, and a problem with some of these tools, that there are tools and techniques out there to solve. So we've certainly taken some tools with things like vector databases to resolve those, and to make sure that our deployments can't give incorrect information. But that's probably the biggest problem, is how do you manage that hallucination issue, and how do you make sure that the answers you get back are the actual real answers? And unfortunately with some of these tools, again, they're quite black box. I remember, I asked, I think it was back Bard before it became Gemini, I asked Bard a few years ago, or a few months ago, how far in advance do people tend to book this hotel? And it was a random question to try and understand some details about a hotel, and it gave me an answer of, people tend to book this hotel 60 days in advance. And then I interestingly asked it, well, how do you get that information? I said, I stayed there. And that was the answer from the kind of Bard, which, it just shows you just got to be very careful in how you use these tools. And they are very powerful, but they've got to be used with knowledge and the right approach to them.
Yeah. And do you foresee a specific governance team eventually within each organisation looking after AI, or would that sit within existing governance teams? Because there's a lot of talk, obviously there was the summit that was a big talking point a few months back. How do you see governance overlapping with AI?
I think at the moment the problem is that people don't yet know how to govern it, or what rules are going to be needed, and how and the same way they don't know how to use it, they don't know how to set guardrails and boundaries around it. I think over time that will become clearer, and there'll become more of a rule book and a best practice that develops around it. And it's because the tools have developed faster than the industries using them have developed. But in the same way, when you build a credit model, you'll probably have holdout samples, you might have an out of time sample, and there's best practice of ways of building a credit model. those same best practice tools and techniques. And hey, if you're going to ask that kind of question, it's got to be via a vector database. You put the data in, and you've controlled the temperature to 0 so it doesn't guess. And there's lots of things you can do to make them work better. And I think as time goes on, there will be guardrails that second line of defense teams and other teams will put in place to say, if you're building it like this, then these are the things you need to have done to make sure it gives you the right answer.
Yeah, it's really interesting. And we've definitely seen, I'm sure you felt this as well, but over the years, credit risk, a traditional credit risk analyst has become more and more focused on data science. And it'll be really interesting to see how AI forms with risk. And I'm sure there'll be a relationship there. Tim, something I know you really wanted to talk about today, and again, we were chatting about it earlier, was Inviso, and you gave everyone a bit of an idea as to what you guys do there. But I know you've recently done a sort of brand refresh, and be a great opportunity to talk a bit about that now.
Yeah, great. So we're Inviso. We've been around for a couple of years. We were set up to help payment acquirers manage the risk of their merchants. So I gave the example earlier of you process payments for, let's say, a furniture company, and they're due to deliver a sofa, and someone buys a sofa that's meant to be delivered in 60 days' time. If they go bust, that customer's going to want their money back. They didn't get their sofa, and the person in the value chain, in the kind of payments chain that has to pay that money out, is the merchant acquirer. Historically, the legacy approach has largely, for them managing that risk, has largely been them taking some form of collateral or delaying payout to the merchant and not giving them the money. But you can imagine the pain that causes for a lot of merchants, where they've taken a payment, they're building a sofa for someone, or they're providing goods or services to someone, and they don't get the money until later. And that really constrains the growth rate of a lot of merchants. It puts huge cash flow constraints on a lot of merchants. So we were set up to help manage that risk, and we've actually partnered with some insurance companies. So we've built models on the likelihood of merchants failing. And actually one of the interesting things we've done is we've partnered with credit reference agencies to get data on specifically merchants and their relationship with their merchant acquirers, and have built payment models specifically on payments credit risk. How likely is a merchant to default with respect to their merchant acquirer? And what we see is that the loss rates in payments are much lower than loss rates for lending. So the furniture company is much more likely to deliver the last few sofas than they are to make sure they pay their credit card bill, or they pay their the rent or whatever else it would be. So they're actually the loss rates are much lower, but also the dynamics and the things that predict risk are different between payments and lending. And what that means is that by building models specifically on payments, we've got much better performance. We can understand the risk much better. But by partnering with insurers, we can also provide embedded insurance products so that you can actually insure the risk of a transaction. So if you're an acquirer, you can insure that sofa purchase, and if the company goes bust, the insurer will give you the money back to cover the cost of the chargeback. And that then, as an acquirer, allows you to give the money to the merchant straight away, and the merchant can manage their cash flow much better and grow much more easily. And that is a very interesting kind of dynamic, because it really works out much better for the merchant in most cases, because they get the money much earlier, and the cost of the insurance is generally much lower than the cost of capital. So they really win from this situation. They find it very valuable. The acquirers, in a lot of cases, they shy away from areas where there is credit risk. And they'll shy away from whether it's furniture, travel, and entertainment is another place where you get a lot of this kind of credit risk, education services, gym memberships. And they quite often shy away from these areas. So it opens up ways of them growing. They're growing their top line revenue without having to expand their risk appetite. And obviously the insurers, it's an entirely new category for most insurers. So it's a way for insurers to grow as well. So we like to think we're helping the merchants, the acquirers, and the insurers all grow in new areas, and find a new kind of symbiotic relationship where they can all win together. So that's what we're set up fundamentally to do. But increasingly, we're getting more involved in helping acquirers manage the risk of their merchants more generally beyond credit risk. So, and AI is a huge part of this. Can you tell if they're selling something they're not meant to be selling on the website? Are they breaching any scheme rules? Are they breaching any laws? Can you spot transaction laundering by looking at the stuff they're selling on the website versus the transaction data we're getting in from the acquirer? So we've invested quite heavily in technology and quite heavily in our AI in particular, and genuine AI in our case. We are using large language models for a lot of this stuff.
Not logistic regression.
Exactly, and machine learning models again. not logistic regression. And we're getting some great responses. And we presented at Merchant Payment Ecosystem last month, get a huge reaction there, and getting a lot of demand. So we've done very well over the last couple of years. We're one of the companies that managed to generate some really good VC investment despite the current dry patch. And that's really allowed us to kind of make some great headway and progress and bring us some great customers and have a great pipeline of new ones coming through as well.
Awesome. And I think if we're not going to show the website on this podcast, but we're going to put a link in, and everyone can check that out. And Tim's absolutely bang on. It's a super slick business model, not one I've come across that often, but I think that's why it's so unique. But I think that's probably everything. We've covered loads. Tim, it's been absolutely fascinating talking to you. I think just to pick your brains on risk, and your career is so interesting. I think to get an understanding of where you think things might be going as well was super interesting. Something that we do every podcast is the previous guest asked a question for the current guest. You've kind of answered the question already, because it's where does AI sit within your business? So you've answered that very well, but we do want a question for our next guest. So if you could let us know what that is, that would be great.
Sure. Well, let me take it back to the more traditional kind of credit risk and the intersection between credit risk and governance. Consumer duty is a huge topic at the moment. So it's the new FCA set of regulations around how businesses protect customers and how they look after the interests of customers. That's pretty new. It's come in over the last year. And it seems to be having a very big impact, particularly in the near prime sector. So I'd love to hear views on what the next guest sees from consumer duty, what they feel it's doing. Is it having the desired impact? And what ramifications does it have? Awesome.
Good question. Thanks, Tim. And thanks for coming on.
Thank you.
And thanks to everyone who was listening as well. For anything data talent solutions focused, please visit harnham.com. And thanks, and we'll see you next time.
Thanks for tuning in to today's episode, brought to you by the Harnham Group. We'd love it if you would share the podcast on social media and leave a comment or a review to help us reach a bigger audience. If your company is having difficulty finding skilled data professionals, you can rely on the global leader in data and analytics recruitment, staffing and talent development to assist you with your hiring needs. Find out more at www.harnham.com. Thank you for listening.